For investors, there are basically two ways to make money from owning a company's stock. The first is to sell your shares for more than you paid for them and pocket the difference. That's known as a capital gain. The second is to hold onto your shares and collect dividends, cash that many companies regularly pay out to their shareholders. To compare dividends among different companies, investors use a term called dividend yield, a percentage that represents the ratio of the annual dividend against the company's share price. Dividends can be a big deal for a couple of reasons. Dividend payments can help boost the return on your investment. They can be especially helpful when the price of a stock drops. Say a stock's share price falls 5% in a year. If its dividend payments that year worked out to 2% of its starting price, your loss would be just 3%. And over time, dividends can add a surprising amount to a stock's overall return, especially if you sign up to have your dividends reinvested to buy more of the company's stock. Say back in 1960, your grandparents put $10,000 into stocks. If their investment matched the price return of the S&P 500, it would have grown to almost $630,000 by 2020. Not bad. But if your grandparents reinvested all their dividends, they would have finished 2020 with more than $3.8 million, about 5 times as much. Just remember that dividends generally count as income, which means you'll pay taxes on them. Of course, you won't pay annual income taxes on dividends in tax-advantaged accounts such as 401ks and IRAs. As with any other investment decision, think through the reason you're buying dividend stocks and how they fit into your overall investment strategy. Dividend stocks can be a nice twofer for your portfolio. Almost by definition, companies that pay a regular dividend are companies that regularly turn a profit. Consistent profits may help drive long-term growth at a manageable level of risk. Keep in mind that not all companies pay dividends all the time. For example, it took Microsoft 28 years before it started paying out. Dividend stocks can also provide a source of relatively reliable, consistent income. Bonds are the traditional way to invest for income, but they pay extremely low interest rates these days. So, regular dividend payments may come in extra handy. If you don't want to select individual stocks, consider mutual funds and exchange-traded funds, otherwise known as ETFs, that target stocks with strong dividend payments. They can be a good way to add the benefits of dividend investing to your portfolio without putting all your eggs in one basket.